This lesson, we're going to start talking about actual tax forms that you complete and you send to the IRS at the end of each calendar year. And the first two forms we're going to talk about is Forms 1040EZ and Forms 1040A. And these are designated for two very special tax filers. Only single persons or married couples filing together with no kids. So these two forms are the ones you're going to use if you're single or if you're married with no kids, either 1040EZ or Form 1040. So remember, as the course of the year goes on, your employer is going to withhold federal taxes, state taxes, local income taxes, if there are any, from your pay stubs, and they're going to all be sent to the IRS, which is the agency that collects these funds. At the end of the year, you're going to fill out one of these tax forms. If you have paid too much, then you're going to receive a refund from the IRS. If you have paid in too little, then you're going to have to make up the difference and pay that to the IRS. So as your employer withholds more than the tax you owe, like I said, you're going to get a refund, and if it's not enough, then you'll get a bill from the IRS saying that you owe that money. So let's look at a situation here where Elizabeth, she's a food editor for a magazine. She's received her W-2 from her employer and also a 1099 form. Remember, a 1099 form was another form showing that you made money, but it was separate from your wages. So on this W-2 form, this shows that she made $83,600. Here was her federal taxes, her Social Security, her Medicare, her state taxes. But this was her income, $83,600. On her 1099, it shows that she made $956 in interest, so probably from a bank account or some other interest-bearing account. So we're going to focus on Form 1040EZ, and you must be single or married filing together with no kids, no dependents other than yourself and your spouse. If your income is less than $100,000, then you can use this form. If it's more than $100,000, then you cannot use this form. You have to use a different IRS tax form. Your income is only from wages, salaries, tips, scholarships. There's no crazy income coming in from anything. It's just these basic income sources. Your taxable interest is not over $1,500. Her interest that she was sent for her 1099 was only $956. So her gross income, as reported on her W-2, like we said, was $83,600 on the other form, on the W-2. And this is what her interest income is. So if you add this up, she's made $84,556, which is under the $100,000 limit to file with the 1040EZ, that form 1040EZ. Since she's filing as a single taxpayer, no one can claim her as a dependent. She can take a deduction from her adjusted gross income. Now, when this book was printed, that deduction was $8,950, but that is out of date, so we are not going to use that amount. If you are a single taxpayer and you file Form 1040EZ, the deduction that you can make is actually going to be $12,400. So it's went up significantly. Now, what this means is whatever your income is, you can take this amount off of your income, and you're only going to be taxed on the difference of these two amounts. Okay, so when she goes to fill out her Form 1040EZ, and here's a copy of the first page, you have to fill out your name, your address, your Social Security number. Here's the $83,600 that she made. Here's her interest income. Here's the total of those two amounts, what I had circled up here. Now she's going to take a deduction of $12,400. So even though she made this amount, she's not going to be taxed on this amount. She's going to be taxed on $12,400 less than that. So to figure out what she's going to be taxed on, I would just subtract these two numbers. So 84556 minus 12,400, that's a deduction. So her taxable income is going to drop to 72,156. So now she's not going to be taxed on what everything she earned, but a smaller amount, which is good for the taxpayer. So this next question says, how would Elizabeth's tax form above differ if she were married, filing a joint return, assuming that her spouse had no income to report? So Elizabeth is working. She makes the same amount of money. She's married. Her spouse is not working. Okay, so here's how it changes. This deduction for $12,400 is per person. So since she would be married now in this scenario, she gets another deduction for another $12,400 for a total of $24,800. So now this line, instead of reading $12,400, would now read $24,800. So we would subtract these two amounts. So 84,556 minus, instead of 12,400, it'd be 24,800. So now her taxable income, instead of 72,156, if she was married and her income and her spouse did not work, then her taxable income, she'd only be charged taxes on this amount, 59,756. So her taxable income would go down, which means her tax bill would go down. Okay, so let's figure out what Elizabeth's taxes would be. So through employer withholding, Elizabeth has already paid in $15,884. That was referenced right here, $15,884. She already paid in taxes. Okay, she must use the tax tables to determine how much taxes she owes. From the tax table, Elizabeth owes, well, this number's not going to be right because we changed this. So her taxable income is $72,156. Okay, so this tax table is going to be wrong because we're using 72,156. So I went online and I found the tax tables, and we're going to be at 72,156. Which is going to be, if we're single, 72,156. Her taxes are $11,669. See, her income falls between 72,150 and 72,200. So her tax liability is going to be $11,669. So let's use that. $11,669 is her taxes. Okay. Now she's already paid in $15,884 to her federal income taxes. Okay. And her federal income tax bill is this much. So what she paid in was $15,884, but she only owes $11,669. Okay, so guess what? She's paid in more than what she owes. So she's going to get a refund. And the refund is going to be the difference in the dollar amounts. So $15,884 minus $11,669. She's going to get a big refund of $4,215. She gets a refund. So this was what she paid in. This is what she owed. So this is her refund. If you are owed a refund, then the IRS will either mail you a check, or if you notice, she's included her bank information on her tax return so she can just get a direct deposit, which is quicker. I know some direct deposits from the IRS, you can get them as little as 10 days. If you're waiting on a check to be received, then that could take months. And that's 1040 EZ. Leo is filling out his 1040 EZ form. His employer withheld $12,907 in federal taxes. He has calculated that he owes this much. So he had this much withheld. He owes this much. So he's going to be short. So he's going to have to owe the IRS whatever the difference is. He owes $13,952. He had withheld $12,907, so a difference of $1,045. So he's going to owe $1,045. Okay, so we're going to walk through Form 1040A, which is for tax filers that have children or dependents. You can use 1040A. Remember, if you have dependents, you cannot use Form 1040EZ. 1040EZ is like a really quick tax return for tax filers that are single or married filing together, and they don't have a lot of tax situations going on during the year. So it's why it's called an EZ form, 1040 EZ. But a 1040A is if you start adding things in the mix like dependents, then you're going to move on to a different form. So, for example, Kenya and Robin Omar, they're married, they have a child, which means they cannot use 1040 EZ, they have to use Form 1040A. Okay, they received $987 in interest and $1,200 in stock dividends. So here are their W-2s. So Robin made $65,120.97, and Kenya made $52,126. So this is just based on their W-2s. Okay, again, they have a dependent child, so they can't use Form 1040 EZ. So exemptions are what tax filers can take to reduce their taxes. It's basically how many dependents they're going to be, how many dependents there are on their tax form. So as you can see, we're filling out 1040A, and we have Kenya and Robin, and this is their child, Robert. Okay, so they have 2 exemptions for themselves and 1 exemption for Robert. So they're going to have 3 exemptions total. We move on to the next page. It says, what is the Omar's adjusted gross income? Well, this is their income from their W-2s, so you add those up. Remember, gross income is what they bring home. They also have interest income. So if we take this amount plus the interest plus the dividends and add them all up, $119,435 would be their adjusted gross income. That is what they made for the year. They don't have any adjustments to make, and adjustments are just things that would come off of your taxable income, off of your gross income. Let's look at a situation like this. Lisa and Bob have a combined income from salaries of $87,980. They received 1099s for $1,100 and $1,300 in stock dividends, and they have $4,000 in adjustments to their gross income. So their adjusted gross income would be after adjustment. So this much plus this, and then minus the $4,000. So the adjusted gross income would be $87,980 plus $1,100 plus $1,300. It's $90,380 minus the adjustment of $4,000 gives us $86,380. So their adjusted gross income would be $86,380. Okay, last thing we want to talk about is the standard deduction. A deduction is something that allows you to reduce the amount of taxes that you owe. These amounts are set by the government, and they do change from year to year. And the ones that the book is using is from 2008, so they're 13 years old. But the tables are found in the back of the textbook. And if you look in the folder, I will have copies of the tax tables that you're going to be able to use. The Omars are married and filing a joint return, and so they can take a standard deduction of $10,900, and that's going to be in the tax tables. Since they are claiming 3 exemptions, remember, themselves and their child, they can reduce their adjusted gross income by 3 times the exemption deduction amount. In this case, 3 times $3,500, which is $10,500. So their taxable income, what we come up with, their adjusted gross income, minus the standard deduction, minus their exemption deduction, which was 3 times $3,500 or $10,500, leaves a taxable income of this. So then you go to the tax tables, Find their adjusted gross income, and this tells you this was if they were single. This is because they're married, filing jointly. So their taxes would be $17,194. That's the amount that they owe. So again, if they withheld enough, then they'd get a refund. If they did not withhold enough, then they would owe the IRS.